Welcome to this presentation on how to discount your liabilities as a quant. So, when we talk about liability discounting, the first thing that comes to mind is IFRS 13 and FAS 157. So, IFRS 13 and FAS 157 tell us that liabilities should be discounted at market rates, which sounds pretty obvious, sounds pretty uncontroversial. However, it was pretty controversial when it was first brought out. And the reason for that is that there are lots of unintended consequences to this sort of market discounting of liabilities. The main problem with that is as credit quality of an entity deteriorates, its credit becomes cheaper and therefore its liabilities become less valuable. And that leads to its balance sheet improving and to balance sheet gains. So these are so-called own credit gains. Now own credit gains are pretty strange kind of gains. It's impossible for equity holders to benefit from them. Debt holders definitely do not benefit from own credit gains. And it turns out, well, because it's impossible for investors to benefit from these gains, they're not actually gains at all. What they are is they're an accident of accounting rules. Another set of regulations where liability discounting is treated directly is Solvency II for insurers, and specifically something called the matching adjustment rule. So under the matching adjustment rule, if a liability cash flow is closely matched to some asset cash flow, and closely matched means to be closely matched in timing, in currency, etc. So if liability cash flow is closely matched to an asset cash flow, then it can be discounted pretty aggressively. On the other hand, liability cash flows which are not closely matched to an asset have to be discounted very conservatively. Now if you look at these two rules, they actually contradict one another, and we'll go over that in detail a bit later during this presentation. So the focus of this presentation is purely how can we find some universally good way to discount liabilities. In other words, if we looked at this as a quant who just landed on this planet from Mars, and we asked ourselves what was the best way to treat liabilities, what would we come up with? So here's the overview of this presentation. So I'll start by talking about how to model simple project SPVs as a quant. And the reason for that is that a project SPV is pretty much the simplest type of corporate that has assets and liabilities on its books. So we'll first go into how something like that would be modeled, and obviously as part of that we'll see how liabilities would be discounted in that particular case. Then we'll take one step back from that. We'll have a look at all the lessons we've learned with project SPVs, and we'll try to see what, if anything, we can take to the bigger problem, which is how to discount liabilities in general. Finally, we'll see what our brand new liability discounting method tells us about asset liability matching. In other words, is there anything about portfolio construction that will be different in this new method. So let's start. So the first section is how to model simple project SPVs as a quant. So project SPVs come up in all sorts of projects. So we have infrastructure projects, real estate projects. Here are some pictures of bridges, then airports, etc. So by project SPV we mean a special purpose vehicle, so that's typically a limited liability entity which is specially set up to hold the equity and the debt of the project. So the SPV will raise the equity and debt from the investors. The SPV holds any assets and liabilities of the project, and passes on any benefit finally to the equity holders. So the advantages of developing projects through SPVs are plentiful, and the main two that people usually quote is, first of all, it's not on company's balance sheet. The SPV is a limited liability company, so all the liability is contained in the SPV itself. And secondly, it's transparent and cheap for investors, right? I mean, if as an investor you want to invest in, say, this airport or this bridge, it allows you to invest in it directly rather than investing in some big corporate which will have a bunch of different assets and liabilities on its balance sheet. So in other words, it allows you to take direct exposure to the particular asset that you want to be exposed to. So modeling these SPVs can be fairly simple, but it can be fairly complicated, and I'll go through one of these modeling approaches, which falls somewhere halfway in between of being very simple and being very complicated. So we'll start by describing the cash flow modeling that comes into such an SPV model. Then we'll talk a little bit about the quantitative aspects of this sort of modeling. We'll go over some variations, so how much richness there is in these models. We'll briefly discuss some historical examples, and then I'll work through a detailed example in quite some amount of detail. So let's get started with cash flow modeling. So what do cash flows of an SPV look like? Well, typically on the debt side, we'll see a loan being drawn and then being repaid at some point in the future. That loan will typically be funded at some funding rate. On the equity side, we'll see some equity injection coming in at some point. The project might be going through, say, construction phase or development phase when it's not making any income. And then after that it will start making some income. Finally, when the loan has to be repaid, we need to in some way realize the value of the project. So either we need to sell the project or we need to roll the loan by realizing its value in some other way. Alright, so these are the cash flows, so now we need to firm up exactly how we model them. So the funding costs, I mean that's pretty simple, so that's typically going to be LIBOR plus spread. In terms of the income, that depends on the type of the project, on the duration of the project. It could be fixed income, it could be inflation-linked income, so for example for these bridges and airports, also for commercial real estate, we'd be looking at inflation-linked income. It could be index-linked to some other index, so for example commodity trade finance projects will be linked to some commodity price index, etc. When it comes to realizing the project value, there will be some proxy index or basket describing the overall sector. So for example, it could be a real estate basket, or it could be some infrastructure basket, or it could be some, say, oil basket or something like that. And then on top of that, there will be some idiosyncratic risk factors which will describe the risk of this particular project insofar as it differs from the rest of the market. So these are now all the cash flows in this SPV, and then the final step is to make this SPV defaultable. In other words, to give the equity holder an option to cancel. Now, if the equity holder exercises this option, he will no longer benefit from this SPV, so he will have he will no longer have any claim to any of the income of the project. He'll have no claim to the residual value of the assets. On the other hand, he'll have no liabilities for the funding cost, and he'll have no liabilities to repay the loan. So when it comes to cash flow modeling, what's important is to incorporate all the risks of the SPV. So if there's any market links, any project links, any idiosyncratic factors, we need to model that in as much detail as we possibly can. Alright, so let's discuss the quantitative aspects of this sort of model. So in this sort of setup, well, we'll obviously have equity holders and debt holders. Now, the equity holders are effectively long the outright, so they're long the actual project, and they're also long a put. In other words, they can lose some amount of money, but there is a limit to how much they can lose, i.e. the initial equity. So when you net these two off, it turns out the equity holder is long some type of call option on the entire project. The debt holder is short a put. Is this same put that the equity holder is long, the debt holder is short. However, the debt holder is long the recovery. In other words, what remains after the option was exercised. Once the equity holder decides to exercise their option, the debt holder becomes promoted to, say, equity, if it was a mezzanine debt holder. So what this boils down to is a Merton type model with American exercise. So the option here is the option to default, and the equity holder has this optionality. He can exercise that option anytime he wants, but he only gets to exercise it once. So that's the all the optionality that the equity holder has, right? He gets to pick the time of default, and he has to manage this optionality in a way that will maximize his shareholders' P&L. Now, sometimes that may be to default never, and sometimes that may be to default today, and sometimes that may be to just wait until something happens before he defaults. So the equity holders have effectively bought this put from the debt holders, and the overall cost of credit is the cost of this American put. So how does that compare to other structural models? Well, in a classical Merton model, the equity holder has the option to default once at maturity. Then we have a whole class of these Merton type models, which are basically barrier models. So their default happens if assets fall below some value and all liabilities increase beyond some value. In our SPV model, we have an equity holder who has an option to choose the time of default. He can default anytime he likes, but at most once. So once he's exercised that option, he loses everything, including the option. So the equity holder obviously has to actively manage this optionality in a way that will maximize his shareholders' P&L. The equity holders have, as we said, bought this put from debt holders, and the cost of credit is the cost of this put on the net cash flows. So when it comes to modeling, we'll pick two extreme case scenarios. So we have a value type project, so that's a project which makes zero to no income, so where purely the bet is on increase of the value of the underlying project. And on the other hand, we have an income type project, so this is a project which does not necessarily appreciate in value, but which generates income. And the reason why I'm putting them up here is because for those two projects it becomes fairly easy to model the actual credit curves. So here we're showing the equivalent CDS curves for a value project that's at the money. So at the money means that the the value of the the value of the debt is basically at par. The project is out of money if the value of the debt is below par. It's at the money if the value of the debt is at par, and it's in the money if the value of the debt is above par. So as we can see, you can put together these CDS curves. So what happens here qualitatively? By the way, these are the exact same curves on the left and on the right. It's just on the left they're plotted on linear scale, and on the right they're plotted on log scale. So what happens? Well, the income projects, when they're out of money, well, we see that the credit curve slopes downwards. In other words, if the project is out of money, then basically the value of the debt is much higher than the value of the total project, and then it makes sense for the equity holder to default immediately. If it's at the money or in the money, then typically it doesn't make sense for the equity holder to default immediately, which is why the credit curve starts low or at zero, but then at one point it does maximize. So there's at some point there's the maximum likelihood that the project will go out of money. And then for the income project, for the income project, the more time that passes, the more the income gets paid out, so then the actual value to be saved by defaulting becomes lower and lower, and that's why the curves again go to zero. Now if you contrast that to the value project, in the value project it doesn't matter how much time passes because, well, none of the value has been passed on to the equity holders, and therefore there's no such decrease to zero when we come to the maturity of the project. Alright, so in terms of quantitative aspects, this is pretty consistent with market standard models, so it's basically fairly similar to the classical Merton model and Merton type models, and it allows us to build reasonably realistic looking credit curves. Now, obviously this is a fairly simple case, so the credit curve family is a fairly simple family. However, you can see how if we made this a bit more complicated, that we could pretty much build a credit curve that looks like anything that we might want it to look like. Alright, so what sort of variations on this sort of thing can we come up with? Well, first of all, notional structure. What we had there was single drawdown and single bullet repayment. Obviously this could be more complicated, so we could have some sort of step up drawdown and any type of amortizing notional repayment. We could have cross-currency effect, so we could have loan, project income and project resale value all happening in different currencies. We could have construction risk there, so for example in the graph that I showed, the project income starts at some fixed point in the future. However, we could have an additional idiosyncratic risk factor, say driving the start and the quantity of project income and its resale value, etc., etc., etc. Some more factors we can think of, well, for example, if the project had any long-term lease or other types of offtake agreements. Why does that matter? Well, let's say the asset is solid and the lessee defaults on us. Well, that's okay, because we still have a solid asset, so we can replace the defaulted lessee with another lessee. On the other hand, if the asset is underwater and the lessee is solid, again, we're in a pretty good position because the lessee is still paying the rent on the asset, so the fact that the asset is underwater we can live with because we're still making the income from it. So what this boils down to is actually that as an equity holder, what we're holding is some kind of loss to default of asset and lessee, right? If either of them is still good, if the asset is still good or the lessee is still good, we're still in the money. We really need both of them to go under at the same time in order to be out of money. One corollary of that is that obviously now we're exposed to a correlation between asset and lessee. So in other words, well, if we're going to lease out such an asset to somebody long term, we'd really want the lessee to be as uncorrelated to the quality of the asset as possible. Because if they're both going to go down on us, we really don't want them both to go under at the same time. What else can we think of? Well, in terms of putting up any hedges, well, if hedges are done well, they will decrease volatility of the cash flows. On the other hand, if they're not done well, they might also increase the volatility. Now, surprisingly enough, if the volatility was increased, then it makes the option to default more valuable, right? Because the equity holder, their option is a call option, so if the total NPV is more volatile, then obviously the option is more valuable. In other words, what that means is for volatile asset, when it goes under, it might still make sense for the equity holder to keep holding it because there's higher chance of recovery in the future. On the other hand, if an asset is perfectly hedged, if it's properly hedged and it's not very volatile, so once something like that goes underwater, something like, once that goes underwater, there's much less chance of it coming back. So as a corollary of that, hedging is not always good for equity holders, right? Because it decreases the volatility of the project, and therefore it decreases the optionality inherent in the equity. However, hedging is really good for debt holders because, first of all, it makes it less likely that they will go out of money, and secondly, they're short the spot, so they're short in options, so anything that decreases the volatility really works well for debt holders. And that's why we typically see that the hedging is usually mandated by debt holders, and it's the debt holders who need to twist the equity holders' arm into hedging the project. Alright, so in terms of variations, there's obviously quite a lot we can put in there to take such a simple project and make it approximate a complex real-world situation much more closely. So how about some historical examples? Now, the pictures I showed at the beginning of this section were of the Øresund Bridge and Kansai Airport. Now, I personally didn't work on either of them, but I'll just show you two pictures of projects that I did work on. So the first one is One Basingstoke Street. So this is a London office building. It's actually the global headquarters of Standard Chartered Bank. And the other one is Terminal 2 of Sheremetyevo Airport, so that's Moscow's international airport. So in terms of history of these sorts of models, well, they have been used in the past for some pretty high value and high profile trades. So alright, so to put some meat on the bone, I'll just work through one simple example in some detail using a commercial package. So we'll show how to model a simple example in FinCAD F3. And this is our simple example, right? It's a real estate asset purchased for 100 million euro. It's financed by 90 million euro loan, so 90% loan, 90% loan to value. It's financed as a 5-year bullet at 6-month Euribor plus 200 basis points. The rent starts at 10 million a year, and it increases annually linked to HSCPXT, the harmonized index of consumer prices excluding tobacco. And finally, when it comes to the tracking index for resale value, we can use EPRA Europe. Alright, so there's different components to this, and I'm not going to go into detail. So the first component is the funding leg. So the funding leg says, well, basically from the moment the loan is drawn down for the next 5 years, so until maturity, with a schedule following 6-month Euribor, we'll pay 6-month Euribor plus 200 basis points on 90 million euro. So I say this is what we're paying as the equity holder. Then we have the loan bullet repayment, so that's when the repayment is due, we have to pay 90 million euro fixed. And again, this is what you pay. Then we have our income leg. So the income leg again starts from the outset here, it goes on for 5 years and it happens annually. So what does this do? Well, without going into detail, inside we have these increases linked to increase in HSCPXT. Then from that we subtract rent risk factor. So rent risk factor will be some project idiosyncratic factor which will describe to us how the quality of our asset might deteriorate, and therefore it might drive the rental amounts down, so either lower than is contractually agreed for long-term leases, or just lower in terms of what can be received in the market for a deteriorated asset. So now whatever happens with this rent risk factor, it cannot drive the rent to be negative, which is why this thing is all floored at 0. And then that's our rent per unit, and then we multiply that by some occupancy factor tracking how many units are being leased at any point in time. So we said this starts at 10 million euro, it goes up by this floating index that I described, and this is something that we receive. So in terms of modeling these project idiosyncratic factors, let's have a look at the occupancy factor. So for the occupancy factor, if we want to model it, we again need to build some forward curves, some volatilities, and some correlations. So in terms of the forward curve, so that's in the table on the left side. So we assume that our occupancy starts at, let's say, 40%. It grows, it maxes out at, say, 70% occupancy, so this is due to long-term leases. And then once long-term leases start expiring, our expected occupancy will go down, because by this point the project will have dated, and we may not be able to sell any more long-term leases. In terms of volatility, well, in the early days before too many long-term leases have been sold, volatility is high. Then midway through the project, most of the long-term leases have been sold, so the volatilities are low. And then as the long-term leases start expiring, then volatility of the occupancy factor increases. The final component is the project resale value. So we said that happens at maturity, and it's 100 million times the increase in EPRA plus some, again, idiosyncratic factor, which we call sale risk factor, which in this case might lead to our project outperforming EPRA, or it might lead to our project underperforming EPRA. So then we take these four legs: the funding leg, the income leg, the loan bullet repayment leg, and the project sale leg. We put them into a portfolio, and then that portfolio contains all the cash flows of our project. If we had any swaps, hedges, or offtake agreements, we could put them into the same portfolio to account for how they affect the economics of the project. And then the final component is to make it defaultable, in other words, to give the equity holder an option to cancel. So here we're creating a cancelable product, so where the cancellation rights are held by the equity holder. They start when the loan is drawn, they end when the loan is repaid, and they follow the same schedule as the loan payments, so as the funding payments and the bullet repayment. And then finally, when it comes to pricing something like this, we would use multi-factor cross-asset American Monte Carlo. American, well, because obviously there's this American option to cancel, or well, Bermudan option in this particular case, and cross-asset because, well, in this fairly simple example, we've had LIBORs, inflation, and EPRA is an equity index. So even in the simplest example we can think of, there's, well, three asset classes, to say the least. Alright, so one thing I'd like you to remember from this detailed example is not so much the details, but the fact that it is fairly straightforward to model something like this in commercially available libraries. So that brings me to the end of this section on SPV modeling. Now, the SPV model shows us how we can start from nothing and then end up building something fairly impressive. So, what's our conclusion? How do we model simple project SPVs as a quant? Well, we model them as assets minus liabilities plus the option to default. Alright, so let's now move to our next part of this presentation. What, if anything, does this tell us about discounting liabilities in general? How should we discount our liabilities as quants? Well, we said liability discounting basically we need to account for assets minus liabilities plus option to default. How is this different than IFRS 13? Now, obviously, on default probability is the exercise probability of this option to default. So how is it different than IFRS 13? Well, it's not. It's the exact same thing, right? The issue here is that own credit gains appear if own default probability is applied only to liabilities and not to the assets. Because that's what leads to liabilities deteriorating and assets remaining the same, and that's where the own credit gain comes from. So these are the accounting gains. So what this boils down to is that IFRS 13 is actually incomplete. It doesn't address this resulting mismatch between assets and liabilities, right? It allows liabilities to deteriorate and assets to remain the same. And that's why we see the accounting gains under IFRS 13. But that now leads us to a conundrum, right? Because why should own default probability apply to our assets? Now, surely the value of any assets that we have is independent of who owns them, right? And yes, it is. Our assets will have the exact same value regardless of whether we default or not. The only thing is, if we default, our assets won't be our assets anymore. And that's the key here, right? Because if we sold our assets, now we can sell our assets when we're just one day away from defaulting, but the reality is that doesn't change anything, right? All that does is it converts them from physical assets into cash. In other words, all we've done is we've shortened the duration on the asset side by selling the cash. We haven't actually changed the P&L at all. So now we have to think about the conceptual difference between the price of these assets and their value. And there is a big fundamental difference between the price and the value of our assets. And let me just explain that a little bit. So the price here is the objective price of these assets, right? The price is what somebody else would pay for them. In other words, if we were to sell them, this is the amount of cash that we would receive, or some equivalent of that. On the other hand, the value is typically used to describe things that are subjective. So this is what this particular asset is worth to us. Now, in this particular paradigm that we're looking at, the value will be our price times our own survival probability. So in other words, this says, yes, we can get some objective price for these assets. However, if we're defaulting, well, there's less and less of this price that we actually get to realize, and that gets to improve our own balance sheet. So how should we discount our liabilities as a quant? Well, the key here is that actually discounting liabilities at market is fine. The actual question is something else, right? The question is, how should we discount our assets as a quant? And the point here is that we have to reflect the fact that our shareholders will no longer benefit from our assets once we've defaulted. So that's the key difference here, right? Once we've defaulted, yes, the assets are still there. However, our shareholders lose any claim on them. And that's the key here, right? There's nothing wrong with discounting liabilities at market. However, there is a problem with on the asset side. So here is a simple diagram, right? So we've got this cash flow that we're owed in the future. And typically, we would ask ourselves, who is paying me this, and will they still be alive to pay it? However, a question we probably don't ask ourselves often enough is, well, we are receiving this, and will we still be alive to receive it? In other words, will we default before this cash flow occurs? And obviously, once we've defaulted before the cash flow occurs, we will have nothing out of it because it won't be ours anymore. So now it turns out that on the asset side, we again have a first to default, and this is a first to default of us and the pair, right? Because if either the pair or we default before this cash flow is paid, well, we will have nothing out of it, either because it won't be paid or because it won't be paid to us. So what this means is we're no longer discounting assets at market rates. We're discounting them at this first to default of us and the pair. So actually our discounting is much more aggressive here than it would be at the market. So what's the bottom line? Is IFRS 13 right or wrong? Well, it turns out it's a trick question. It's right to discount liabilities at market, but it's wrong to discount assets at market, because we have to incorporate our own default probability into discounting of our assets, because that's the only way we can account for the fact that once we've defaulted, we no longer benefit from these assets. What about our second example from the beginning, Solvency II? How about this matching adjustment rule? Well, that's a bit trickier. So, just to remind ourselves, what the matching adjustment rule says is that liabilities that are closely matched to assets can be discounted heavily. Does that make sense? Yeah, obviously, it doesn't make any sense whatsoever, right? Because if our liabilities are closely matched to assets, then they have very, very low probability of never being paid, right? All we're doing is we're passing asset cash flow through to the liabilities. Now, if they have low default probability, then they should be expensive, not cheap, right? Well, it turns out if our assets are closely matched to liabilities, then our assets improve as well from the point of on default risk, because then we're much less likely to default on these liabilities. And then as the assets and liabilities both improve, it turns out the assets improve faster than the liabilities, and therefore the P&L still improves. However, the reason why it improves is very different to the reason that the matching adjustment rule things. It improves because the assets are improving faster than liabilities. It does not improve because the liabilities deteriorate in any way, shape, or form. So, how should we discount our liabilities as a quant? Well, we should discount it the same way we always discounted them, at our own funding rates. However, we have to change how we discount our assets. And when it comes to discounting our assets, we have to account for our own default risk. Alright, so now a very short section at the end. How do we manage our own assets and liabilities as a consequence of all that? In other words, does any of this have any implications to portfolio construction? How should we construct our portfolios? Well, let's pick 2 examples just to illustrate the point. So let's say we have our first example, which is a long-dated asset and a short-dated liability. Now, a long-dated asset will be subject to own default risk, right? The longer we have to wait, the less likely it is that we're still alive when the asset pays us. On the other hand, if we flip that, if we have a short-dated asset and a long-dated liability, it turns out the long-dated liability is now subject to own default risk. The longer we wait now, the less likely it is that we're still alive when we have to pay the liability. So that now brings us to a fairly surprising point about portfolio construction, namely that if we shorten the duration of our assets and lengthen the duration of our liabilities, we'd improve our P&L from the standpoint of own default risk, right? Because if we bring our assets closer, then that makes it less likely that we will default before these assets pay. And if we send our liabilities further out in the future, well, that makes it more likely that we will have defaulted before they have to pay. So that makes our liabilities go down. Now, does that make any sense whatsoever? That sounds like the exact opposite of what anybody should be doing, right? If we have a look at any yield curve anywhere, we have a short end where the curve pays low yield, and then we have a long end where the curve pays high yield. Now, what we actually make is the yield on our assets minus the yield on our liabilities. That's just banking 101, right? How do banks work? Well, they take in short-dated deposits and pay low rate on them, and they give out long-dated loans, so they generate long-dated assets on which they receive a high rate. So the whole concept of having short-dated liabilities and long-dated assets is how we're supposed to make money. If we flip that, if we made our assets short-dated and liabilities long-dated, well, we would just be bleeding money every day, right? So that clearly doesn't make any sense. So if you wanted to kind of draw a schematic diagram of something like this, it would look a bit like this, right? So here on the x-axis we have, let's say, the ratio of asset duration to our liability duration. So when that's very low, so when our assets are shorter than our liabilities, then obviously we're in this inverted yield curve situation. So we're doing the opposite of what any bank would be doing. So we're making the low yield at the short end of the curve, and we're paying the high yield at the long end of the curve. So that brings us to negative cash flows, and that's why at the low end we're out of money. On the very long end, so if our assets are too long dated and our liabilities are too short dated, well, that means that we might default before our assets pay us anything. And then again, that drives the value of our assets down relative to our liabilities, and again, we're losing money from the standpoint of own default risk. So on the left hand side, we're basically paying the steepness of the curve, and on the right hand side of the graph, we're paying our own default probability. So somewhere in between those, there's a sweet spot where we should be making money. So, what's the bottom line of this? How should we manage our ALM as a quant? Well, it turns out there is an optimal ratio of asset duration to liability duration which will maximize our P&L. That particular optimal ratio will be driven by our own default probability, and our own default probability in turn depends on our asset liability mix. So actually, when it comes to optimizing this isn't a straightforward optimization process. It's actually pretty complicated. However, I think the graph that I showed on the previous page illustrates why there is this optimal ratio. Alright, thanks very much. I can take any questions now.